Before we get into the smart stuff, granolas is a new term, right? I didn't just imagine this.
Well, we came up with it a couple of years ago, during the pandemic, actually, and we picked the 11 largest companies in Europe. And it was largely because we wanted to show that the largest companies in Europe are not banks, they're not oil companies, they're not autos, they're actually tech stocks, healthcare companies and branded consumer goods.
I mean, it's a fascinating story, but let's dive into it from a sectoral standpoint. Healthcare seems to be the outperformer. Weight loss drugs are all the rage from a fundamental standpoint. But I'm curious about getting into healthcare when it is famously a pretty risky business, especially when you're talking about biotech. It is you're either kind of win the lottery or you lose out in a really, really big way. And you've seen that time and time again until now, where even this morning you're seeing this divergence between healthcare and broader tech. How do you interpret that?
Yeah, so the ones we've got in the granolas, the biggest companies in Europe, they're big cap pharmaceutical companies. And absolutely, they do take on some risks, obviously, but they tend to develop drugs in the later stages, and they tend to have bigger pipelines, they tend to have huge R&D. And as your previous speaker said, you actually often find that these companies have really good balance sheets as well. So we don't see them as risky as the biotechs.
How do you push back against the valuation line, then, the critique that the valuation is screaming stretched on some of these stocks?
Yeah, I think, I mean, something like the granolas, they trade at about a 30-40% premium, PE premium to the European market. That is a little bit expensive, but they have a lot more growth. The problem is the rest of the European market isn't growing that fast. The economy is close to flatlining the last few quarters. These companies have got global footprints and growth which is high single-digit.
So to be clear, they're somewhat detached from the soggy growth picture that we're seeing in the Eurozone. So as we project out to the rest of the year and we're looking at essentially flat growth for Europe, the granola stocks can continue to power ahead. Even as China remains a big question mark, there's stagnant growth in the Eurozone. They're detached from those economic fundamentals at this point. I
mean, we as Goldman Sachs as a house have a bit more of a rosy picture on growth, it's fair to say. But even our rosy picture on European growth is just about 0.7% GDP growth for this year for Europe. I mean, that's not huge. I do think the granolas, though, who have a global footprint, have great businesses with great margins, are investing in growth very much like the Magnificent Seven. They're investing in R&D, they're investing in growth capex to generate that sort of barriers to entry, that better global growth and footprint. We think they can generate that.
I'm just reading parts of your research here. 60% of the past year's gains coming from these granolas companies. You highlighted, though, it's all about margin, this magnificent margin, if I can even call it that. Although I feel like I'm mixing metaphors. When we're talking about the margin growth, though, when does that stop? These numbers ultimately, it's kind of like, I made this reference a couple of weeks ago. It's like making an A+ on your report card for years and then getting an A-, and suddenly you feel like, oh my God, you're failing. How does that work in terms of the margin growth for some of these companies? When does the party stop?
Yeah, look, companies, you often find the sort of winners of the last 10 years are rarely exactly the same winners in the next 10 years. Sure. The interesting thing, though, these companies, and I think coming back to this point, they have very good balance sheets in a higher interest rate environment, which we're in now. That's a brilliant asset to have and gives you some barrier to entry because other new entrants can't easily come in and compete when they would have to build up a balance sheet at much higher risk and much higher cost. So you have already a good balance sheet. You're already using your cash on your balance sheet to invest as well in R&D and capex to give you that growth. So I do think these types of big cap companies with a global footprint that have a stability of margin is exactly what people are looking for in this environment.